In FY 2025, 91% of individual traders in India lost money in the derivatives market. Retail losses crossed 1,05,000 crore rupees, a 41% jump from the previous year. And even though the NIFTY kept rising, major brokers like Groww, Zerodha and Angel One together lost more than 2 million active users in just 6 months. The question now is simple. Is India's trading boom collapsing or just evolving into something smarter? To understand that, we have to look at what's changed culturally. For decades, trading was seen as risky, something your parents warned you about. But between 2020 and 2023, that mindset flipped completely. Lockdowns created time, apps created access, and suddenly anyone with a smartphone could open a demat account in minutes. Trading became the new badge of independence. YouTube channels started posting 500 to 50,000 rupees challenges. Telegram groups promised daily tips. Finfluencers showed profit screenshots as proof of skill on Instagram every single day. By FY21, India had added 14 million new demat accounts, more than the previous 5 years combined. Retail participation in derivatives jumped from 12% to 37%. Trading wasn't just finance anymore, it became a statement, a mix of ambition, rebellion, and modernity. But like every cultural wave, it peaked. By FY25, the illusion broke. According to SEBI's data, 91% of FNO traders lost money. The average loss was over 1 lakh rupees per person. Only 9% made any profit at all, and just 1% earned more than a lakh. The pattern was the same everywhere, across age, city, and broker. Half the traders placed fewer than 10 trades a year and still lost money. Another 10% traded hundreds of times and they lost even more. By mid-2025, India's largest brokers were watching active client numbers fall fast. The market's turnover stayed high, but that activity wasn't coming from individuals anymore. It was dominated by automated systems and institutional desks. This isn't unique to India. Every young market goes through this phase. In the US, the meme stock mania of 2021 ended the same way. A flood of retail traders who mistook volatility for skill. China's 2015 retail boom collapsed after a wave of short-term speculation. In South Korea, household debt from margin trading now exceeds the country's GDP. The pattern repeats everywhere. Access grows faster than understanding. People enter markets before learning how they work, and sooner or later, regulation steps in to bring balance. India is simply entering that stage of maturity right now. Regulation steps in. By late 2024, India's derivatives turnover was nearly 7 times larger than its cash market, a ratio even higher than the US before the 2008 crisis. Retail speculation had started to outweigh investment, so SEBI intervened. Margins were tightened, lot sizes were increased, weekly expiries were reduced, and in April 2024, the securities transaction tax on options was raised. The effect was immediate. Volumes cooled, brokerage revenues dropped, volatility stabilized. It wasn't punishment, it was correction. As one SEBI official put it, we can't shut the market, we just need to keep participation rational. SEBI didn't end trading, it forced it to grow up. You know the irony in all this? Retail traders today have access to more data and technology than ever before. They can backtest, scan charts, watch live analytics, and learn from thousands of online creators. Yet results haven't improved because the problem is a lack of information. It's too much of it. When everyone trades the same signal, the edge disappears. In the end, success doesn't come from collecting data, it comes from filtering it. The traders who survive now are the ones who know what to ignore: technology and the human gap. And then there's the structural change. Technology has rewritten the battlefield. More than 65% of FNO orders on the NSE are now executed by algorithms. Institutional servers sit within meters of the exchange gateway. Retail traders sit miles away trading on Wi-Fi. This isn't the same game anymore. Algorithms don't hesitate. They don't chase losses. They don't sleep. They read data, act, and exit before emotion even loads. The competition isn't retail versus institutions anymore. It's human emotions versus machine execution. And that's a fine emotion, but speed alone doesn't explain why 9 out of 10 lose money. Traders get overconfident after small wins. They hold losing trades because they hope it will bounce. They refuse to take stop losses because they keep hoping it will break even. SEBI's own data shows traders add to losing positions almost twice as often as to winning ones. That's not bad strategy, that's human instinct. And when instinct meets leverage, probability wins every single time. Brokers have understood this shift. The dependence on FNO volume is becoming dangerous. Groww still earns around 60% of its revenue from derivatives, but that number is falling as it expands into mutual funds, wealth management, and advisory. Zerodha and Angel One are following the same path. Analysts estimate that even a 5% drop in FNO trades can reduce brokerage profits by nearly the same margin. So, the entire industry is diversifying, moving from turnover to trust, from trading revenue to long-term client relationships. Retail is evolving. The truth is, retail investors aren't leaving, they are migrating. Systematic investment plans or SIPs hit an all-time record of 21,000 crore rupees in September 2025, up from 8,000 in 2020. ETF participation is at historic highs, and the average holding period for new investors has nearly doubled from 11 months to 22. People aren't quitting the markets, they're just approaching them differently, slower, steadier, smarter. The next 5 years will be about professionalization. Prop firms will expand, funded trading models will grow, brokers will integrate education, capital, and analytics. Trading will stop being a side hustle and become a specialized career path. In this ecosystem, certification and discipline will matter as much as market calls. It's not about predicting price anymore, it's about building process. The next generation of traders will behave less like gamblers and more like engineers, testing systems, measuring inputs, refining execution. There's also a quieter truth here. Social media turned trading into identity. Profits became content, losses became silence. Most traders didn't just lose money, they lost confidence. They stopped posting, stopped talking, and quietly exited the space. Because in a culture that worships screenshots, failure has no place. But the traders who stay now are different. They don't need to prove anything online. They're learning in private, refining in silence, and focusing on longevity. A small group of traders is still here. The one who journal, review, and trade smaller. They don't chase every setup. They wait for quality. They have realized that consistency doesn't trend, it compounds. They're not loud, but they're still standing. And they'll likely be the foundation of India's next serious trading generation. So in conclusion, is day trading dead in India? No, the noises. The 2020 trading boom was built on leverage, hype, and luck. The 2025 market is being rebuilt on structure, discipline, and data. Retail traders haven't disappeared, they have just grown up. The casino era is closing, the professional era is beginning, and honestly, that might be the healthiest thing that's happened to Indian markets.